These are the 5 stories making the business headlines in sub-Saharan Africa this week. First up, South Africa's Labour Department and Chinese tech giant Huawei. The former is negotiating a possible out-of-court settlement with a subsidiary of the latter, according to Huawei and a government official. Authorities took Huawei Technologies South Africa to court this month, stating it had not met a requirement that 60% of workers be South African. Another legal dispute is playing out between Nigeria and JP Morgan. A court in the UK capital London began to hear a lawsuit on Wednesday, in which Nigeria claims more than $1.7 billion for the US bank's role in a disputed 2011 oil fields deal. The civil suit relates to the purchase by energy majors Shell and Eni of the offshore OPL 245 oil field in Nigeria. JP Morgan has said it is confident that it acted appropriately. Oil also making headlines in Namibia, where Total Energies said on Thursday that it has made a significant discovery of light oil and associated gas off the coast. A source told Reuters the find, the second major discovery off Namibia's coast in a month, was more than 1 billion barrels of oil equivalent. In Ethiopia on Tuesday, Prime Minister Abiy Ahmed announced plans to open up the banking industry. It's one of the last major sectors of the economy still to be liberalised since Abiy took office in 2018. And lastly, diamond company De Beers is bringing its sales activities back to Botswana's capital, Gaborone. Pre-sale viewings were moved from Botswana in May 2020, when travel restrictions prevented international customers from flying to the southern African country amid the global health crisis.
The Dow on Friday registered its biggest daily percentage gain since November 2020 as the market rebounded for a second day from the sharp sell-off leading up to Russia's invasion of Ukraine. The Dow closed up 2.5%, the S&P 500 gained 2.2%, and the Nasdaq added 1.6%. Adam Coons is portfolio manager at Winthrop Capital Management.
I think you're seeing some of the uncertainty of what's going to happen in the geopolitical environment start to wash its way through the market. So that's why you're seeing a rally. You saw a quick reversal yesterday. The probability of Putin moving beyond Ukraine is extremely low. And so the contagion through the global economy is also extremely low.
Oil prices fell below $100 a barrel, easing some concerns about higher energy costs. Russian missiles pounded Kyiv and families took cover in shelters on Friday, a day after Russia unleashed a 3-pronged invasion of Ukraine in the biggest attack on a European state since World War II. Investors also assessed the news that Russian President Vladimir Putin told his Chinese counterpart Xi Jinping in a call that Russia was willing to hold high-level talks with Ukraine, according to China's foreign ministry. Some strategists say the prior stock selling may have been overdone, noting that economic fundamentals and corporate health remain favorable. Healthcare gave the S&P its biggest boost on Friday. Shares of Johnson & Johnson climbed 5% after a U.S. judge ruled that the drug maker's subsidiary can remain in bankruptcy, preventing plaintiffs from pursuing 38,000 lawsuits against the company, alleging its baby powder and other talc products cause cancer.
Global stocks calmed on Friday after a tough Thursday. Russia's invasion of Ukraine had sent oil prices to their highest in years and drove big sell-offs in stock markets. But a late Thursday rally on Wall Street was followed Friday by a degree of recovery in Europe and Asia. The key pan-European stock 600 bounced back from 9-month lows. It rose 1.7% in early trade, driven largely by the utilities and real estate sectors. Oliver Roth is an equities specialist at Oddo BHF.
Markets have recovered, and the reason is the war in Ukraine, because it will relieve the ECB from pressure to raise interest rates at the end of the year already, even if inflation should increase. That at least is the expectation of some of the investors and bargain hunters who are active on the market again.
In Russia, stock markets soared around 20% after the previous day's huge sell-off. The Russian ruble slightly recovered after it hit all-time lows. Europe's partial recovery followed similar moves in Asia. MSCI's broadest index of Asia-Pacific shares outside Japan gained about 0.8%. Japan's Nikkei rose close to 2%. But some analysts worry any rallies could be brief due to worries about the impact of Western sanctions on Russia's ability to export crude and fuel. Oil prices again jumped on Friday by nearly 3% to almost $102 a barrel. Brent crude went above $100 a barrel for the first time since 2014 on Thursday. Markets also fear inflation could heat up further in the Eurozone due to its reliance on Russian gas supplies.
Russia banned UK airlines from its airspace on Friday. It appears to be a tit-for-tat move after Britain banned Russian flights from landing. British Airways said it would reroute services to Asia in response. Virgin Atlantic said the same, apologising to customers for longer flight times to countries like India and Pakistan. Flight tracking apps showed planes from both carriers taking a southerly route to avoid Russia. It's all just one aspect of a mounting problem for air travel firms. Airspace in Ukraine, Moldova, parts of Belarus and southern Russia has been shut since Ukraine was invaded on Thursday. Now airlines have to assess the risk of flying over Russia at all. Japan Airlines cancelled its Thursday flight to Moscow citing security worries. Emirates says it has rerouted some services, leading to longer flight times. Industry body Ops Group says aircraft flying over Russia need to have a contingency plan in case the airspace is suddenly closed. Rising oil prices add to the pain. Crude has soared above $100 per barrel since fighting began, raising costs for airlines still reeling from the global health crisis.